Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review, this time for the week ending March 22nd, 2024. So the story of the week, of course, was the Federal Reserve's decision on Wednesday. No change on the leading rate, but we did get a good dose of guidance about how the Fed is seeing the rest of the year for their monetary policy. And there's this unwritten rule which has been pretty constant through time, that the Fed doesn't start a new trend in monetary policy, like start cuts or start hikes, too close to a presidential election. It's not something that is written into law, but it's something that we've seen time and time again in the past. The Fed wants to avoid seeming political. So that means that there's a window between now and likely June to get moving for the Federal Reserve. And if they don't move by this summer, maybe that means that they cannot get moving until early 2025. Again, this is not a written rule, but this is something that's been pretty constant through time. So that if they start moving, they can continue their move through the Federal Reserve. But it's very rare in history, actually pretty much never happened, that the Fed started moving really close to the federal election. So we're kind of in this situation here, and Mr. Powell, during the press conference on Wednesday, seemed like someone who is setting the table for cuts starting sooner rather than later, so starting this summer, even if inflation right now is reaccelerating and economic growth also is reaccelerating. So based on the data, you would say that, well, the timing doesn't seem good at all to start cutting, even though that you can say, well, there's reasons to be confident that in the long run inflation will converge towards 2%, but starting moving now with inflation reaccelerating, that was the topic of last week's review, so you can always refer to that. It seems a bit off, and this is something that we noted, we debated internally at IA Global Asset Management all week, and we feel that there's a risk here. Risk for upwards, for flaring up of risk appetite in the markets if inflation is accelerating, and yet we have rate cuts. So nominal economic growth could be supported. Lower rates, of course, this is good for equities. Of course, this is good for gold if rates starts to fall as inflation is rising. Of course, if nominal growth is set to be pushed higher for the considerable future, not very positive for long-term interest rates. So there's market impacts that could be significant coming from this course if the Fed decides to go this way. So that's kind of the story of the week. So if we look at how markets reacted to that, well, the stock market, we see, I would say, a deep black here. When I say deep black, that means that if the trend continues, and as I'm recording this, it's Friday morning prior to market open, but futures are up. So that would be the best week on Wall Street for 2024. Year is still young, but that would be the best week of the year. For rates, the Universe Index was higher in Canada. Longer term bonds did underperform with negative performance here. Oil going nowhere. Currencies, some volatility through the week, but gold benefited strongly from that. So again, there's not much better environment for gold than when inflation is rising and yet rates are falling. That's kind of the Goldilocks situation here. Mentioned last week that we do have a position in gold. We even decided to double the size of this position. It was a small position. Now it's not as small as it was, let's say, but to raise the weight of gold in our portfolios, there's a good environment here for gold to continue to outperform. So going into the details here of the Fed's decision. So a few quotes here. When you read them, you say, well, it doesn't seem that out of line. But when you listened to the press conference, you did feel that Mr. Powell was trying to get across the message that recent inflationary pressures might just be a bump in the road, as he said. Need to look through that, and it seems like he wanted to pass along the message that it's time to cut. So we feel that it's kind of difficult to say that you're data dependent and ignore recent inflationary pressures. But that seems to be the thinking at the Fed. Maybe they're right, maybe we're wrong, but still we feel that this creates a shift in the investment environment, an investing environment, if they decide to go this way, and inflationary pressures remain sticky as we see them through our analysis. So a few of the charts that were proposed by the Fed through their summary of economic projections. Here on the left you have the forecasts from the Fed for growth, so GDP growth. So they see GDP growth as being stronger than what was expected last time that they made a projection, that was in December. Unemployment rate slightly lower, and inflation, they see it as being stronger. So again, kind of flies in the face of it's time to start cutting when you're revising upwards GDP growth and inflationary pressures. It's not like the Fed is saying that we're going to start cutting and we're going to be cutting very fast. Here, the charts that you see here, this is the famous dot plot. So we were mentioning that last week, that there was a risk that there was a revision to the dot plot for 2024. Maybe the FOMC members would be signaling 2 cuts rather than 3. Well, we got no move this week. So it's still 3 cuts that are expected for 2024. This is on the left of your screen here. On the right, you have 2025, 2026. And for both, again, it's 3 cuts per year. So the Fed is not signaling that it's time to go and to go fast. It's more the path that they are signaling is that let's start cutting early and move slowly. So 3 cuts in 2024, 3 cuts in 2025, 3 cuts in 2026. So this is the forecast from the Fed. Of course, these things, you can see the dynamic in the chart, they move through time. So let's see how they see things when we're in 2025 and 2026. But this is the signaling that we're seeing here. Just to wrap everything together here, I'm bringing back the same chart that I presented last week, just to show how our thinking, where our thinking is anchored. So if you take the pace of monthly inflation over the last 3 or 6 months, you have something that's in the vicinity of 0.3 to 0.4% month over month, whether you look at total inflation, core inflation. So we've seen a flaring up, let's say, of inflationary pressure. And if we continue going that way, and you can make a case that you can continue going that way, because now we're seeing supply pressures, pressure on the supply chain reappearing slowly. Gasoline prices have been rebounding. Wage pressures remain an issue. Leading indicators of inflation are pointing toward risks for an upward move in the second half of the year. So all of these pile up. Well, if you think that you're going to see a reacceleration, at least a steady pace of growth for the monthly figure of 0.3 to 0.4, just like we've had over the last 3 to 6 months, that brings you to June, where we would see inflation on an uptrend between 3 and 6%, 3.6 and 4% year over year. So it will be interesting if the Fed decides to cut in June while inflation is reaccelerating. So there's a risk that they're not, able to move to follow through with that plan, or there's going to be a risk that communication could be a bit complicated when it happens. So those are the risks that we are seeing. So just to wrap everything together, we are seeing a risk that there's a policy mistake from the Fed in trying to move too early. While inflation is reaccelerating, cutting rates to us early in June seems to be a risk. That could, of course, shift the investing environment. If you have lower rates while you have a reaccelerating nominal growth, it could fuel this nominal growth, meaning that it could be an even better environment for risk taking. So it should support equities. Of course, it supports gold if you have falling rates while inflation is accelerating. Of course, higher nominal growth for the considerable future should push longer rates higher. So it's not really constructive for long bonds. So what to watch next week in the data? In Canada, we'll have the CFIB Business Barometer. We'll also have GDP growth for January, which should be reaccelerating on a monthly basis. But year over year, we continue to see a deceleration of Canadian GDP to 0.8% annualized. Durable goods orders in the U.S. should be strong. Consumer confidence should be a little bit stronger than last month, but not by a wide margin. And finally, PCE core inflation should be going sideways, still at the upper end of the range for the Fed's mandate at around 2.8%. So let's see if next week we have signs of reacceleration again of inflation based on the PCE core measure. So that wraps it up for the week. ia.ca/economy for this review for the podcast, iagam.ca/insights for all of the material produced by iagam. Always a pleasure to serve you. I'll see you again next week.